Coty actually beat consensus revenue estimates for Q4 fiscal 2026, delivering $1.269 billion.
Right, which is up 1.3% on a reported basis.
Yeah, but that top-line beat is, well, it's a trap for retail investors. They missed on the bottom line with an adjusted EPS loss of 2 cents.
Which was worse than the expected 1-cent loss, yeah.
Exactly.
And, I mean, the guidance just threw fuel on the fire. Management entirely withheld their full-year fiscal 27 guidance.
Wow. Entirely withheld.
Completely. For Q1, they're projecting like-for-like revenue to actually drop, low to mid-single digits, with Q1 EPS sitting at just 11 to 13 cents.
And the market reaction was just ruthless.
Oh, absolutely. The stock tanked over 17% pre-market, down to $2.50. RBC Capital even slashed its price target from $8 all the way down to $3.
So a top-line revenue beat usually gets you excited.
Yeah.
But to understand why the market panicked instead, you really have to look under the hood at Coty's margin compression and segment fundamentals.
Yeah, looking closely at those segments, Prestige brought in nearly $772 million.
Which looks like a 1% gain on paper.
Right, but it's actually down 0.5% on a like-for-like basis. And Consumer Beauty hit about $497 million, which is down 3% like-for-like.
Ouch.
The real bloodbath, though, was profitability. Adjusted gross margins compressed 140 basis points to 60.9%.
Right, and that 1.3% reported revenue growth we mentioned at the top is basically a retail illusion. Coty had a 3% currency tailwind that completely masked a 1% organic decline.
Yeah, they aren't actually moving more product. Favorable foreign exchange rates just made it look that way on the headline.
Exactly.
And because they aren't moving as much product, they're getting hammered by lower volume cost absorption.
Right, because when your factories run below capacity, you still have to pay the fixed costs to keep the lights on.
Which eats directly into your profit margins. Combine that with excess inventory and, tariffs, and the margins shrink fast. The crucial takeaway here for you is that Coty's sellout trends, meaning the volume consumers are actually buying off the shelves, are noticeably lagging behind the broader beauty market's growth.
Because of these lagging fundamentals, management is declaring fiscal 2027 a transition year. They're launching a massive strategic review to deal with this looming structural revenue cliff.
And the sheer drop off that cliff is the Gucci exit. By fiscal 2028, Coty is returning the Gucci beauty license to Kering for $400 million in cash.
Just to size that up for you, Gucci currently accounts for a low double-digit percentage of Coty's total revenue. Here is where I really have to push back on management strategy, though.
Oh, really?
Yeah, returning the Gucci license feels like a massive, unforced error. Sure, $400 million in cash sounds great today, but losing Gucci isn't just losing revenue. It's like a basketball team losing its star scorer right before the playoffs.
That is a great way to put it.
Right. Without that premier luxury draw, how do you replace those points? How do you convince department stores to give prime shelf space to Coty's lower-tier consumer brands?
It's a very real concern. I mean, Coty's mitigation strategy to replace those points revolves around aggressive right-sizing. They are slashing consumer beauty SKUs by 20% to clear out underperforming shelf space.
Okay.
And they're ramping up a fixed cost reduction plan. Essentially, they want a leaner operation to bridge the revenue gap.
But the risks remain elevated, right?
Yeah.
For example, the ongoing Middle East conflict already hit sales by about 1% this quarter. And we should note, we are just objectively reporting what's in the earnings report here.
Right, purely looking at the numbers. And looking ahead, that conflict poses a $20 to $30 million oil-related COGS headwind.
So if organic sales are shrinking, margins are compressing, and they're losing their Halo brand, what exactly is the long-term play for the balance sheet?
It's purely a defensive maneuver at this point. Coty's is taking the $750 million from their recent Wella stake monetization, combining it with that Gucci buyout cash, and using it to aggressively pay down their $2.9 billion net debt.
So they're essentially just buying time to right-size the ship before the structural changes fully hit.
Exactly. They need to improve their leverage ratios quickly.
Which leaves you with a final provocative thought to mull over. Can a beauty conglomerate successfully shrink its way to profitability, or is losing a halo brand like Gucci a permanent blemish on the portfolio?
That is the big question.
We'll see if that retail illusion we talked about earlier can ever transform into a genuine fundamental turnaround. Make sure to follow the show for your daily earnings coverage.